Well, Affle India is buzzing in trade on the back of a solid set of numbers in the second quarter. We have Mr. Anuj Khanna Soham, the CMD and CEO of the company, who joins us. Hi, sir. Congratulations. Solid set of numbers. Let's just pull up a wider time horizon in terms of the stock move, and the IPO investors will be very, very happy because the stock has given good returns. What the investors would like to know, though, is what's the outlook for the second half of the year. So, sir, could you tell us the first half of the year, you've seen a solid growth in terms of revenues. Margins as well have improved by roughly around 150 basis points. First half of the year, you're 39% higher in terms of revenues. Remaining of the year, what can you do?
Well, thank you so much for having me on your show. I think we would like to thank the investors for the support through the IPO. And yes, the results of H1 this year is very positive, both on revenue as well as on the bottom line performance, where on the EBITDA growth, we have seen 47.1% up from last year. And on PAT, it's almost 60% at 59.7%. And you're seeing a PAT margin improvement year on year in H1 of 2.3%. I think that's a very outstanding performance, and I think our team is full of passion and try to continue these growth trends going forward, at least from a consistent seasonality point of view. You would see in our business in H1 versus H2, where due to the October, November, December, this current quarter and the festive season with Dussehra, Diwali, New Year, Christmas has a lift effect overall.
Right.
Year on year, we've seen that. And typically H2 is much better in terms of revenue performance than H1. So from a serialized basis, H1 to H2 should be a higher revenue than H1, and consequently on bottom line as well, we should see a good trend line there. So yeah, I think the investors should be fairly excited about what to expect going forward as well.
Anuj, just some numbers. So for second half of the year, how much higher could the growth be compared to first half? And you've managed to expand your margins. Your other expenses have come down. How did what was the leverage which kicked in? And can your margins expand in the second half further?
See, while we are a growth-oriented company, we are also very, very bottom-line, financially sensible company. We are consistently investing in all the key areas where growth for the future is going to come from. So if you look at our data and inventory costs, we have actually invested more in this area versus what we did in H1. If you look at the operating expenses and employee costs, we have ramped up and launched a new R&D center in Bangalore, and we have increased our investments in tech as well. So all the areas where one needs to invest, we are doing that sensibly. Yes, in terms of other expenses, we have been also efficient, but that's largely because the revenue is growing faster. And as a percentage of the absolute number and the expense, the total OPEX is not growing as fast, and therefore the bottom line efficiencies will come in. And we will continue to see that as we are an asset-light business model and a very scalable tech platform-based business model. Unlike IT services, where revenue growth must be matched with OPEX growth, in our case, the tech platform is a very scalable business model for us. We never provide any particular guidance on, a quarter or a particular financial year. But what I can tell you is that there are very strong growth drivers at an industry level in our business. The first and the biggest growth factor is that the consumers, people like you and me who are smartphone users, are increasingly spending more and more time on our smart devices. The second is that we are also transacting more on smart devices with online payments. And the average value of each transaction is also going up. So when we look at that trend line, there is no option for the advertisers and the marketeers across all industry segments where we work, which is e-commerce, travel and transport, fintech, and BFSI, or even OTT entertainment and gaming, and all these categories of advertisers are increasingly spending a bigger part of their marketing spends on digital, on data-led programmatic consumer platform-based advertising, which Affle offers. And I think this is a trend that will continue over the next 5 years, because none of us as consumers are going to use the smartphones any lesser as we go along.
Anuj, your India business is growing at a faster clip. In the past quarter, on a year-on-year basis, that's up more than 75%. But the outside India business, that's growing at a slower clip. I think that's up only in double digits, at around 11% odd. Margins as well have compressed a tad bit. What's going on with the...
May I just interrupt you? Actually, that's not the right way to look at our business. I think you're looking at the company level accounting versus looking at its segment level accounting. There's an investor's presentation on our investor relations website that can be referred. There is a particular slide on CPCU business in there which talks about how India versus overall growth on converted users is growing. So if you look at that, you'll find that we are delivering 35.1 million converted users overall. And yes, India is growing a little bit faster. We're growing over 60% on the India CPCU business. In the rest of the world business, we are growing about 25% in terms of, so in, let's say India, we're growing faster than industry growth. And in international business, we are growing at par with industry growth. But even within international business, we are actually growing faster than industry metrics in other emerging markets like Southeast Asia, Middle East, Africa. So if we look at India, Southeast Asia, Middle East, Africa, Affle is beating industry growth trends very comfortably. On the CPCU business in particular, on that particular slide I was referring you to, you would see that our business at an aggregate level across India and international is actually growing 45%. And this is 90% of our revenue comes from this segment, and that's growing at 45%. And that's a blended average of India growing close to 65% and international growing around 25%. When you blend that, I don't think there is any concern on non-India business not growing fast enough. And I think we are doing very well overall.
Okay, great. All the best for the second half of the year, Anuj. Congratulations on a good showing in the first half of the year. Your investors will be happy. The stock is up, I think, more than 45%, from the listing price. And in fact, employee cost as well has gone up by close to 40%. As you said, it's an investment. So your investors as well as your employees seem to be happy. Now, interesting to see whether you deliver on the commitments that you've laid out for the second half of the year.
And Nomura has laid out a target price of 1900 in a report which they released today and is sharing coverage with a buy rating 1900. So it's still some 400 rupees upside, according to Nomura at least. We'll get into a break then.
All right, we get into a break. You come back. One more point, Rima, on the company. It was added to the MSCI small cap index, I think. So on the back of that, there were flows as well that moved to the company. And on the back of that, we did see a sharper jump up out there. I think the listing price was at around 940 odd. So the stock has given very, very good returns. Now moving to the high point of the day post that interview. We'll slip into a short break. Come back. We'll get you snippets of our conversation with the former vice chairman of the Niti Aayog, Arvind Panagria, on the other side of the short break.